Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Wednesday. It is March the 13th. Over the past week or so, we've seen a lot of noise in the media about Petrobras. Lots of news going on about the dividends. And as you all know by now, I don't really like noise in my portfolio. So the question is, what do we do about this, if anything at all? So what I thought I would do is share a little bit of my homework that I've been doing with you and see if we can find something that might be interesting here. And specifically, what I want to do is pose the question, perhaps not just to myself, but also to you. Do we jump off the balcony here on Petrobras and jump straight into Equinor? And what the heck is Equinor anyway? This is a stock I have not covered before. You might know it by a different name, but I'm just going to focus on Equinor for now. And we're going to talk a little bit about Equinor and decide if there's something we need to do with Petrobras or not. So let's get into it here and we'll take a deep dive. But before we do that, I just want to quickly reflect on the winner of my last video comment section. So in this particular instance, Bulldogs made a comment to the last video I made, which was about the 4% rule for old fossils like me, for retirees, right? Anyway, Bulldog says, I'm following the 8% rule. An 8% dividend on $1 million in energy transfer delivers $80,000 annually in dividends. That's a sweet deal, right? So, of course, there's some risk attached to single stock, and especially when you put all your eggs in one basket. But energy transfer has been a phenomenal performer for us since Bulldog's number one highlighted energy transfer for me way back in, I think, 2020 or maybe early 2021. So let's look at these state-owned energy giants, right? So the one I mentioned at the start, which is Petrobras, which has been in the news. I'm going to just cover that very briefly because I don't want to use this video to talk about Petrobras, but I do want to talk about Equinor. So Petrobras, the similarity here is that Petrobras owns directly approximately 50% of Petrobras's common shares and approximately 28, almost 29% of the total share capital. Now, that is an interesting point because when Petrobras cuts the dividends to shareholders, the largest shareholder who will not be getting dividends is the government. Now, firstly, you can pose the question saying, which of these communistic governments do you like best or least? And one, of course, is Brazil, and the other one is Norway. But that's besides the point. Just for a second, if we think about this just for a minute, the socialist Lula, the president of Brazil, has basically said that Petrobras should focus on giving money back to the people and not just reward the shareholders. Ironically, the largest shareholder is the government of Brazil, which means that if the government of Brazil doesn't receive the money from the superb dividends, juicy dividends that Petrobras has been paying out, then they will be less likely to be able to help their people. And you could say, arguably, that it is the government's responsibility to take care of the needy and the poor and the downtrodden and the widows, etc., rather than the company that is actually producing all capital. So if Petrobras is making a whole lot of money, then the government of Brazil automatically receives a lot of money every time Petrobras richly rewards its shareholders because the government is the largest shareholder. So it's a little bit of a sort of contradiction in terms, telling Petrobras to not pay out dividends or not pay out as high a dividend as what they did before in order to ensure that the Brazilian people benefit from the juicy profits that Petrobras is generating on an ongoing basis. Just down below, Equinor, the Norwegian state, holds approximately 67%, so 2/3 of Equinor is actually held by the government of Norway. So what exactly has been going on with Petrobras? Now, of course, you would have known, or you would know by now, that Petrobras investors, including myself, got a jolt, as Lula has he said. This is a headline from Bloomberg just a couple of days ago. Petrobras Chief Executive Officer Jean-Paul Prates, I hope I'm saying that correctly, said that the company will be cautious on payouts of dividends because it needs to invest in the energy transition to rebuild oil and gas operations abroad. Well, that's government speak, that's political speak. Anytime an energy company says we need to invest in order to focus on energy transition and rebuild oil and gas operations abroad. The second part, rebuild oil and gas operations, is fine. The first part, energy transition, refers to renewables, which is 100% political speak. Most companies that are involved in energy production have actually moved away from renewables, including some of those super majors like BP and Shell. Come last Friday, anyone still waiting for a big payday was left disappointed as Petrobras said it was withholding an extraordinary dividend and its shares tumbled 11%. Now, as I just mentioned a minute ago, the government of Brazil is the largest shareholder of the company, so they didn't get the big payday either, and their shares also tumbled 11%. So talk about cutting off your nose to spite your face or shooting yourself in the foot. That seems to be the socialist way. But anyway, I don't want to make this a political discussion, so we'll just focus on what's happening with these particular companies right now. Now, the first question is Petrobras still a buy or a hold or a sell? What do we do with this? Well, I'm not absolutely convinced that I have the answer for that. So let's just look at some of the fundamentals and then see if we can arrive at a decision. You can buy Petrobras shares on the open market for around $15. These are ADRs, or American Depository Receipts, because I'm a US tax person. You can see it's sort of sitting just right of center in its 52-week range. And of course, that's after the huge pullback, not only 11% last Friday, but even the 5% before that when Protes said that they would be cutting the dividend. Market cap around $100 billion. It's a super major. It's still the cheapest super major that you can buy right now in the marketplace. EPS 3.85, the price earnings ratio less than 4. It's super cheap based on these metrics. The annual dividend yield is still quite juicy at $3. It's yielding almost 20%. You can see at the bottom, not very significant institutional holding, except for the fact, as I said, that the government owns 50% of the company. And of course, not a lot of people are shorting it either. So it's not like everybody is suddenly running away and throwing out the baby with the bathwater. You can see the sudden downturn here on the right-hand side on the graph of Petrobras over the last few days or so. It's taken a bit of a hit. It's been on a nice uptick over the past year. So if you were building the position like I did over the last year, right now I have a cost basis of around $12. The $15 price is actually in the money for me because obviously my cost basis is significantly lower. But one of the primary reasons why I hold Petrobras is because of the juicy dividend. So if they cut the dividend, then keep cutting the dividend. That is not okay by me. However, on the other hand, it still pays a very lucrative dividend to shareholders today, as things stand. What about Equinor? So this is a company I've never covered before, so we're going to talk a little bit here about Equinor, and I'm going to dive just a little bit deeper into its fundamentals. And when I say a little bit, I'm talking about the proverbial 1 inch deep and 5 miles wide, right? So I'm not going right into the filings and into the financials here. I'm just taking a snapshot and seeing whether this is interesting to me at all or not. One of the first reasons why Equinor jumped at me is because it has been a solid underperformer for the last year. In other words, after outperforming the indices around about October, November last year, it just nosedived. Now, I'm not exactly entirely sure or confident enough to share with you why the stock just nosedived, but it's currently trading at $26, and you can see it's sitting way to the left of the 52-week low and high. So arguably, it is cheap not only because it nosedived, but also because it's sitting at the bottom end or near the bottom end of its 52-week range. Like Petrobras, this is a large company. Petrobras with a market cap of nearly 100 billion. This one around $77 billion. The ratios that we typically look at to start with, earnings per share 3.9, price earnings ratio of 6.59. So theoretically speaking, a little bit more expensive on a price earnings ratio basis, forward looking than Petrobras, but very, very nicely priced with a PE ratio of only 6.6. But look at this dividend yield. So it's currently paying out $3.60, which is yielding 14%, $3.60 as a percentage of $26.19 when I took the slide is 14%. Much like the example with Petrobras, held by institutions, is relatively small, but remember, the Norwegian government or the state owns 2/3 of the company, and of course, not a lot of people are selling it short. So based on the snapshot here, Equinor looks like a decent replacement for Petrobras, or perhaps a little bit of a mix or hybrid. We'll get back into that one a little bit later. Looking at top ranks, you can see they rank it neutral. Well, this looks a little bit sort of right of center to me. So the neutral actually looks pretty good. It looks like it's leaning positive. The analysts say it's a moderate buy. We'll talk about that in the next slide. as I go through this with you. The fundamentals are a little bit mixed. Return on equity is pretty good. The asset growth, not so much, and the technicals are negative. The blogger opinions, for what it's worth, are bullish. So you might deduce from this video that I'm bullish as well. But what I'm actually looking for is another undervalued stock like an Occidental Petroleum that also, unlike Occidental Petroleum, pays a nice juicy dividend, which I could possibly use to replace some of my Petrobras with. Now, one of the reasons why the analysts' predictions or price targets are not necessarily that great is because we only have three. We have one buy and two holds. So 3 sell-side analysts are offering a 12-month price target of around average. Well, there's only 3 of them, so average around $30, right? So currently it's trading at 26 something, and they're saying 30 something, right? So it's about a 20% increase from today. But remember, if you do realize a nice uptick from where it's trading today, so if Equinor does go from $26 to say $30 or so, and you score sort of a 15-20% uptick in stock price appreciation, you are also effectively getting an annualized dividend of well over 10%. As the price goes higher, the percentage of the dividend will be lower because the dividend is expressed, the yield is expressed as a percentage of the stock price. So the higher the stock price, the lower the percentage, right? So currently it's yielding 14%. If the stock price goes up to $30, then it might be yielding 12%, but it's still pretty good, right? So if the stock price goes up 10, 15%, and you're getting a 10, 15% dividend, that is a nice juicy return on your investment. Is this company effective? Well, it seems to be doing okay, right? So I don't have full data on this, but I have enough to work with. The industry is currently showing us a return on equity over a TTM, it's trailing 12 months, of around 41, and Equinor is sort of half that at 23. The industry is showing a return on assets of around 11. Equinor is about 8, so it's lagging a little. Return on investment, the industry is at 14, Equinor close to 11. All of these on a trailing 12-month basis. So you could say it is more or less in line with the industry on return on assets and a return on investment point of view, but it is certainly lagging from a return on equity point of view. Its current debt to capital ratio is 39.6, almost 40%. This is pretty standard or normal in the oil, gas, and consumable fuels industry. But the company's balance sheet shows that liquid assets are plentiful enough to serve its current liabilities. How do we know that? Well, the most logical ratio for us to look at is the quick ratio. The quick ratio basically shows you how much cash and cash equivalents you have on hand. Anything that you can put and convert into liquid cash within the next 30 days. In other words, not necessarily inventory and things like that, but the quick ratio looks at your cash and your accounts payable and compares the two. We want to see a number greater than 1. 1.6 is significantly greater than 1. So Equinor looks like it would have no trouble servicing its current liabilities at all, despite the lack of an interest coverage ratio for the most recent quarter, right at the bottom of the screen. How about profitability? Well, here Equinor actually looks a little bit better. It sort of is in line once again, but it at the same time is a little bit better than what it is from an effectiveness point of view. So the gross profit margin of Equinor, almost 55% compared to the industry's 43%, the operating profit margin 33 compared to 22, and the net profit margin, ironically or interestingly enough, is only 11 compared to the industry's 17. So over the past trading 12 months, they've generated a greater number for gross profit and for operating profit, but a smaller number on net profit. One of the reasons for that might be because they are returning so much of their cash to investors. How about the dividend analysis? Since I'm talking about returning cash to investors, it's currently paying a dividend of $3.60, as I mentioned at the start. That currently yields 14% based on the current stock price. The industry overall is actually pretty good, giving an annual dividend yield of almost 4%. That is pretty good. The dividend change, interestingly enough, Equinor has been increasing its dividend, and its dividend growth over the past 3 years has been 60%. So it has actually been returning more money to shareholders than its peers, and by far in comparison. How about growth rate? Are we growing or are we shrinking? Well, the earnings per share growth for the most recent quarter. So we have two different numbers here. MRQ is most recent quarter, TTM is trailing 12 months, right? So for the most recent quarter, it's actually pretty good because it was almost 5 and the industry is negative 33. But over the trailing 12-month period, it's negative 56, while the industry was positive at 10. So a bit of a mixed picture there for us. The same thing happens here with revenue growth for the most recent quarter. Pretty good, 11% compared to the industry's negative 8. And the revenue growth over a trailing 12-month period, unfortunately for Equinor, negative 28% compared to the industry's 10%. So Equinor has to be careful to not focus entirely on renewables, even though Norway has the ability to generate a lot of energy from wind power. What exactly is Equinor? Equinor ASA, formerly Statoil ASA, is a Norway-based international energy company. The company's purpose is to turn natural resources into energy. Equinor sells crude oil and delivers natural gas to the European market. One of the primary reasons why Norway is such a wealthy country is because of energy, period. There's nothing else that has made Norway as rich as it is today other than energy, and Statoil, would now call Equinor, is one of those reasons why. It is also engaged in processing, refining, or offshore wind and carbon capture and storage activities. There's 5 reporting sections. I'm not going to go into any detail on that, but it's just interesting to see the company here. The valuation ratios are relatively good, right? Price earnings 6.5, price to sales 0.73, price to book 1.65, cash flow 3.65, price to cash flow for the trailing 12-month period. You can see that Equinor is at a high just a short while ago, right? So it's sort of towards the end of 2022. It was trading at $42 and now it's down to 26. And then you can see the price performance over here on the left-hand side. You can see sort of how it's done over the most recent period, right? So up a little bit over the last 5 days, but down quite a bit over the last 60 days for sure. How about the historic growth and share detail? Once again, the historic growth looks pretty good here. We have earnings per share 11.69, revenue 6%, dividend 26%, pretty good. I like that one. In fact, that's one of the reasons why Equinor, as I said at the start, drew my attention. Firstly, because of the high dividend. Secondly, because the stock price has just crashed. So now might be a good time to get in. Talk about that more sort of at the end of this video. Equinor is in a class of a depository receipt. So for me, it's an ADR, an American Depository Receipt. 398 institutions hold shares of Equinor, but remember the company is 2/3 owned by the Norwegian state. The balance sheet looks pretty good. It's a very strong position in cash and cash equivalents. Lots of money in the bank, probably arguably as you would expect from a state-owned company. Governments in general have no problem with money. If they need more money, they just print more. Income statement looking a little bit less good, and the cash flow also a little bit less good as it's pulled back, but that's also related to the price of the commodities. If we look at the stock versus its peers, so here I am unfortunately a little bit blinkered because I'm looking at the peers in terms of this comparison purely from a US perspective specifically. But you can see, if you look at this graph here, how Equinor has pretty much tanked while its peers have been doing quite all right, thank you. Now, CVX is Chevron. ConocoPhillips is well known to most of us. Marathon Petroleum is well known. Hess is well known probably to most of us, perhaps a little bit less well known than the others. CVX, is one of the foundational holdings in XLE. I have a large position in XLE, and XLE is approximately 40% split 50-50, so 20% each, Chevron and Exxon. And then the rest of the top 10 of XLE make up companies like some of the companies that are mentioned here. The odd one out here, as I said at the start, because I'm looking at this from a sort of US perspective, is that of these 5 peers, Equinor is the odd one out because it's a Norway state-owned company, whilst the others are US companies that are obviously more publicly traded and more broadly held. If we look at the performance of these companies, so I'm looking at the 5 peers, you can see Chevron is actually down quite a bit, but not as much as Equinor, whereas some of the other companies, especially Marathon Petroleum, has done phenomenally well over the last 1 year. But look at the dividends, right? So Chevron pays a nice juicy dividend of over 4%, but Equinor is at 14%. So if you're looking for a dividend stock to potentially replace Petrobras, Equinor might be something that would be of interest to you. How about the PE? If we use the price earnings ratio only, or maybe as a primary driver for making a decision, you can see from this peer comparison here that Equinor is much more let's call it better priced, I don't want to say cheaper, than these four peers that are up here on the screen at the same time. However, Marathon Petroleum seems to be a pretty good buy as well, except it falls short on the dividend if that is what you're looking for. Not small by any means whatsoever. Total revenue, Chevron as a super major is driving revenue, trading 12 months, almost 200 billion. Equinor is half that size. But look at ConocoPhillips, comparatively, it's only $56 billion. So about a quarter of the size of Chevron and half the size of Equinor. And then you have Marathon Petroleum, that's larger, sort of in between the two. So an interesting snapshot here just to sort of compare. And when I say, do we buy this, do we sell this, or do we hold this? What I'm leaning towards doing is potentially saying, you know, what I could do is I have Petrobras in multiple accounts. I have a cost basis that's lower than the current price. So if I use some of my sort of retirement type accounts. So in the US, we talk about retirement accounts as, IRA or Roth or something like that. In a country like Canada, it would be an RRSP, so registered retirement savings plan. If you hold some Petrobras in one of those accounts and you take profit, you're not creating a tax event because it's in a tax sheltered account. You only create a tax event if you withdraw the money. So like in my own example, just by way of an example, where I have Petrobras in a tax sheltered account, I might look at that account and say, I could exit Petrobras, take a bit of profit. It doesn't create a tax event, so it doesn't cost me anything. I just effectively cash out and bank a little bit of profit. And then I can take that money and buy some Equinor. Or otherwise, what I could do is I could say, I'm going to split my Petrobras position in that particular account in half, take some profit on the half that I sell, and the other half that I hold, I'll just hold and cash that dividend and maybe buy more shares with the DRIP, dividend reinvestment program, and maybe with the other half of the money that I've realized from the sale of half of my Petrobras position, buy the equivalent amount of Equinor. So it's a bit of a hybrid, right? So generally speaking, if I don't like a stock, like for instance, a year ago when Hindenburg attacked ICANN, I just exited ICANN completely and never went back into it again. Petrobras, on the other hand, I exited early last year in January, my entire position. But then over the year, I built back another position in Petrobras again, and it's been a good performer. In fact, it's been one of the best performers in the energy market. So right now I'm in the money on Petrobras. So maybe my sort of I wouldn't say it's where I am right now in terms of having made a decision, but what I feel like doing or think I might be doing is saying I'm going to cash out half of my Petrobras and put that half of the cash into Equinor and maybe see how that goes. There could be a little bit of upside there in addition to a dividend that's not too far off the Petrobras dividend right now. So that's kind of what I'm thinking. At the end of the day, I'm still going to be left with a huge position in Petrobras because most of my Petrobras holdings are not in retirement accounts. But that was kind of one of the ideas I was toying with today as I was looking at Equinor. But do you have Equinor? Do you have Petrobras? Did you sell? Did you decide to hold it? Are you trading it? What are you doing? Maybe you can let me know in the comments. And also, if you do hold Equinor, maybe share your investment thesis with us. But overall, let us know what you think in the comments. Look forward to chatting with you guys. Take care. Bye-bye.